the banking and finance working group, and we've done some work with the blockchain maturity model and various other initiatives. And then we started hosting these monthly webinars so that people can hear about different initiatives in the industry. And fortunately, today we have Nitin Gaur as our guest to be interviewed. Nitin's had a long career with IBM, but was their director of financial sciences and digital assets for a long time. He transitioned to be the global head of digital assets and technology design for State Street, the large trust bank, and is now involved with his own stealth startup. So we might hear something about that. But the goal, our goal is we've termed this in different times. Is it the best of times, the worst of times? What's succeeding in the industry? What are the challenges? And we're going to try and look at sort of the crypto DeFi world in general, and then looking at where the infrastructure is transitioning in that, and then also within TradFi, where's the sort of new national market infrastructure type of initiatives there. So welcome, Nitin, if you want to give yourself an introduction or...
Sure. Thank you, Paul, for that illustrious. And I'm not new to GBA. In fact, Gerald and me have been talking since my IBM days. In IBM, my lion's share of work, which I founded Blockchain Labs, and the intention at the time was 90% of World's Bank were our clients. So I travel literally about 90 plus different countries, central banks engaged in both in terms of supply chain use cases, trade finance use cases, central bank digital currency use cases. So it's been a fairly interesting journey in the last, I would say, 14 plus years, Paul. And as I interacted in State Street, which my journey in State Street were also quite interesting, where the reason why I joined State Street, one, because there was an opportunity. Second thing was an opportunity to learn the nooks and sort of the details of how the capital market infrastructure and the back office and mid office systems work, because that is essentially the plumbing that our existing market infrastructure relies upon. And I had to learn that, which to me was a very enriching experience. And now, just for the audiences, I call it in stealth mode, but I firmly believe that the industry itself is emerging. So DeFi crypto industry for the past 15 years of its evolution has gone to a point that it's big enough, and it began to intersect with the traditional finance. And that intersection today is seen at the instrument class, which is ETFs and some level of wrappers that come into the traditional finance to provide the comfort level that traditional finance needs from its prudential treatment of assets and fiduciary responsibilities as banks have. But I believe there's a lot more to happen in this space, which is why I'm hoping to discuss that today, both in terms of what Paul, me and you have discussed for hours at times as to what that infrastructure should look like. But also I think I have broadly defined the industry into 3 I's, which is infrastructure needed to make all this work, instruments, which is how do the existing instruments need to be tokenized, which is an RWA, the real world asset conversation, but at the same time, there's a huge emerging class of crypto assets that needs to intersect with this world. The second thing is insights, which is not just an AI agenda for the sake of AI agenda, but I believe that you do need a massive, because velocity and veracity of data increases with the velocity of asset movement, and you need new toolings and new infrastructure to be able to support both in terms of things like compliance and things like financial crime settlement, but also the businesses rely upon business systems to make decisions, whether it's liquidity decision or risk decisions. And I believe those 3 I's to me is my guiding thinking to say, what do we need to build to help the industry move forward beyond just the rhetoric. I no longer talk about why tokenization is cool. I think we understand that. Now we talk about what we need to do to make it work. So I'll pause here, Paul, and hand it back to you. Love to get your perspective as well.
Sure. I think, and I'd like to ask you about, in terms of the crypto DeFi world, there's been a lot of innovation around the sort of peer-to-peer settlements and the technology to allow sort of over-the-counter transactions, but there's still some struggles with scale and functionality, and so in terms of that, they are open source, they are public blockchains, and there is this struggle between a regulated industry that needs to protect itself and a somewhat unregulated industry that's got a lot of innovation. So in terms of I see the issue with crypto and DeFi is how can they better serve the TradFi world, but without, but if they're sort of maximalist in terms of retaining public blockchains, open source technology, that can be problematic. But they've also they've tended towards a sort of transient, centralized way of validating their transactions, and that still creates they can suit their use cases, but they can't scale beyond that, and therefore interoperability in layer 2 seems to be the themes. But in terms of your perspective, what's new in the crypto DeFi world at a sort of high level, and where are the successes and where are the struggles?
No, that's a great and loaded question, Paul, as I expect nothing less from you. So let me give you a little perspective, right? That the traditional finance industry, which is sum total of what we classify as 4 asset classes, the securities, the bonds, the cash equivalents, the treasury, the gamut of things globally is about 500 trillion. So if you look at what banks deal with movement of assets, and they use a very complicated micro infrastructure. For example, if you want to deal with dematerialized gold versus bond versus securities, they all have their own micro, infrastructures that deal with them, and eventually they converge into a settlement layer. You need to pay for things, which is the duality of every transaction that you need to settle. And that has led over time, Paul, to this complex, what we call as market infrastructure. And market infrastructure actually comprises of the various market participants, the banks, the broker dealers, the clearing houses, as well as sort of the settlement infrastructure, which makes the entire movement of these different asset class possible. And that has evolved over the last 100 plus years, as you know, and what all we have done is we've digitized it over time. Come in the crypto ecosystem. So crypto ecosystem today is close to about less than $3 trillion worth. So there's still a long way to go for these two. And I have always called the crypto as fifth asset class in general. But if you look at the crypto industry in general, if I were to draw parallels between the existing market infrastructure, this is the complex series of broker dealers, the investment banks, the custody banks, the trust banks, the clearing houses, and the settlement infrastructure that make up our existing financial infrastructure. A lot of these various decentralized players in traditional finance work have been compressed. For example, if you look at Coinbase pretty much is vertically integrated. They provide all services for all asset classes. They're an exchange. They provide custody services. They provide settlement services. They provide payment services. So you begin to see as to how the pendulum has swung from this fragmented market infrastructure into an infrastructure that can lead to participants like Coinbase and many other exchanges and custody providers to be able to compress that entire infrastructure per se. Except that over time, our existing financial infrastructure has gone through various series of faltering, the Bernie Madoffs of the world, or the downtime of systems, which have led to the existing regulation requirements of resiliency and security of the infrastructure, the uptime that's needed, so you can guarantee to say money will be in your bank tomorrow if this transaction goes through, and you can rely upon that financial transaction because there are many linked transactions that goes with it. So our existing financial infrastructure regulation and the guarantees of resilience and security is governed by the likes of FFIEC in the US and many such agencies around the world to ensure that things are secure, especially now with the massive rise in cybersecurity infrastructures, cybersecurity threats. It has extended to all the critical market infrastructures. And if you look at crypto, completely unregulated, still open source, and I would say that it's technology rich. We have enough technology, Paul, as me and you have discussed, to meet all the requirements of the traditional financial infrastructure, except that it's not formalized. And so the way I see these two worlds converge and reconcile, that I find the DeFi protocols and I find many of the smart contract, for example, and many of the layer one, which act as settlement layer in this, are nothing but digital sort of equivalent of the existing world, except that they are either decentralized or they are completely code driven, don't have the burden of the massive sort of full-time employees and a massive infrastructure needed to run and govern these things because they are meant to be self-governed. So it's technology rich, massive amount of potential. The question now is, how do we educate the powers to be, which is the regulatory framework and the College of Regulators around the world, to not only understand the technology and its potential, but also build the guardrails, which provides the same level of guarantees that it aspires to provide for the traditional financial infrastructure in this new world. And I'll say one more thing before I pause and get your perspective, Paul, is that it took us a while. I mean, banks now are comfortable with cloud and internet, but we pretty much do all our transaction on a network that is designed to move information, which is what we know as internet today, right? It took us almost 40 plus years to get to this point where we are now comfortable moving massive amounts of value across internet. And I would draw the parallels that we can probably accelerate not wait for the next 40 years and use this new network of value, as we call it, or internet of value, to evolve and mature and bring this to the mainstream, which allows for us to be able to take advantage of it, because internet was never designed to move value. Over time, we have force fit this technology to be able to move value through ledgers across various ecosystems per se. So I'll pause here without going into a massive rant and see if that even makes sense, Paul.
No, it did. And I've often said the history of TradFi was that each of the products in each of the regions, whether you're buying an equity, a bond, or a derivative, or other things, they tended to be siloed because the industries had expertise. An equity guy was an equity guy, a bond guy was a bond guy, a derivative guy was a derivative guy. And so the technology tended to automate those infrastructures, but it made them siloed and individual. And just as a comparison to the DeFi world, effectively the big banks and brokers became the layer 2 protocol that could link all this infrastructure. But you're now paying a toll to get to all of them. And while there's a flexible front end, there's a lot of chaos and linkages in the background. I think the thing that obviously Ethereum showed early on is it didn't care what you transacted. You just said you were recording a transaction. Now there's a question on how it's recorded because it tends to be a state change, timestamp state change, as opposed to a true ledger. The irony is within the DeFi world is that the different protocols, which are all competing to become, the Ethereum killer, as they talk about, Solana or Cardano or others, is that they've tended to go for different use cases, but then they've customized the smart contract. So they're actually recreating the same issue that historically was in TradFi. That's just, my opinion. But and then the thing that's really preventing them is some of the security and the formalization, which you said, but also, in terms of how can you scale this thing? Because you said it's not just $500 trillion in assets, it's tens of millions of transactions, per day. And therefore you've got to have the ability to absorb that volume and scale. My other thing as well is that both in the traditional finance and in attacking blockchain and Web3 initiatives, and also in DeFi protocol, my criticism has been it's been iteratively developed. They're trying to solve one problem at a time. The problem is when you solve one problem and you haven't thought ahead to the next one, you end up with kludgy or inflexible systems. Certainly with us, with L4S and Tapestry X, we took a holistic view, which is like, okay, I've got to account for all the requirements before I start designing or encoding what I'm building. So that, you've hit this issue of, great, I've got this great way of recording things, but I can't handle the capacity. Okay, so I create side chains or shards. Okay, now I need to invoke scale, and then it's like, now I've got to look at functionality. So I'm creating layer 2 protocols that do derivatives or allow you to lend assets. But now you've got linkages in one protocol to the other. Whereas holistically, if you looked at it and sort of said, if I had to do it from day one, how would I start? And that's just a design approach that obviously I prefer. You're not often given the opportunity because you're usually inheriting something that has to be re-engineered. The best thing about blockchain, it was a completely new technology unimplemented. And so the iterative implementers are hitting their roadblocks. And I'm saying the holistic ones, I think that's the way to cover it, because the one thing that's missing we've had this discussion, which is part of Tapestry X, is that there isn't really formal accounting, double entry accounting in these blockchains. There isn't the concept of payable receivables. And that's where I see, a big, that's the next roadblock in terms of functionality, because it's one thing to say, I've lent you the asset and my terms are in a smart contract, which is an algorithm, as opposed to accrued on a ledger. then that's going to be problematic. So I'm not sure what you think of those.
No, absolutely. There's two things in this. I actually wrote extensively about this, Paul. I think you bring up a really good point because so there are two elements, right? One is we have focused heavily on interoperability because at the end of the day, just like us, when we interact with our broker dealers or some Charles Schwab or Fidelity, the front end of the whole thing, we execute a trade, and we don't care how it interfaces with the rest of the infrastructure or the market ecosystem that provides the demand and supply and deployment of capital and everything else. And what I wrote about this topic was twofold. One is there's an interoperability challenge, interoperability which is between the Ethereum and Solana. All the layers one who are competing to get everybody's transaction. Now it's Solana, Ethereum are two predominant ones. Bitcoin is on its own sort of class of being the store of value and evolving as competing with the likes of gold and everything else as an asset class. But you have all these layer ones which do one simple thing. They provide settlement layer, which our US dollar system provides to the world and to the and to Americans. But then this various layer 2, layer 3 are trying to solve the problem of scalability or security, and that leads to additional asset classes that get born in that system. So now we're dealing with interoperability, not just between the various layer 2, layer 1, and bridging techniques to say, how do I ensure that if I'm moving an asset from Ethereum to Solana, which in today's world, we don't care because we have systems in place to transfer value, albeit it's expensive, it takes time, it's laden with all kinds of challenges, but it's doable. But when you bring this crypto ecosystem to the traditional financial world, we have another burden of interoperability because now have to interoperate with the old ledgering system. So the way I've seen is the likes of BlackRock and State Street and you name the entity, JP Morgan, if they were to deal with digital assets, while blockchain is a ledger system, as you know, Paul, it still is not a system of record because the system of record in banking and financial system is essentially tied around the regulation. So cash management, treasury management systems, multiple accounting book of records. These systems govern a bank. They run the bank because there are risk models, as you know, there's the stress test that we all know about, and the reporting requirement. These reporting requirements come from these systems. And so from that point of view, you cannot rely on the system of record that blockchain contains. So you need a bridging technique that allows you to be able to. So to me, there are two challenges that financial systems need to solve for. One is interoperability between the old and the new, the old ledgering system and the new ledgering system. And second challenge, I would say, is around the operation framework. At the end of the day, if you look at the existing financial systems, they are massive amount of stuff goes into operations. That's what they do. In fact, I don't think banks deal with money anymore. Banks are essentially a massive data processing engines which keep track of how much you own and preserve your ownership records. And they need massive ends of operations to ensure that they're providing you accurate information, one, because it's a legal requirement. The second thing is it's essential to the financial system to preserve the record of ownership, which we take it for granted in crypto ecosystem. So there's a little bit of mismatch between those two systems. And after almost spending 15 years, I decided to spend my time in figuring that bridging issue between the old and the new, which Chainlink has done to a certain extent of bringing the traditional finance to blockchain. But I'm of the opinion that for them to coexist, you cannot do away with the regulated system that keep the bank healthy and that drives the bank. And these are treasury systems and cash systems and liquidity management systems, so on and so forth. So I'll pause here. I think somebody has raised his hand, but to me, that gets me excited, but it's really an interesting problem to solve. And I think, Paul, you're working on it too, I think.
Yeah, no, that's just before we'll leave some time for questions at the end. I'm not going to go run to the full hour here, but the interesting thing and what I saw in the potential of what was blockchain or distributed ledger was, like you said, all these infrastructures in the traditional finance don't talk to each other, and really they're pulling themselves up into an aggregation layer within the big banks and institutions. And in the same way, if you'd have gone pre-internet and said, I can just point and click and communicate with who I want to, people could only think in terms of like, well, you would have had to have had dedicated phone lines. How can you connect without a central authority and not have a one-to-one relationship with all your connections? And the idea that the internet protocol sort of said, hey guys, if we all use the same protocol. We can use a network of network effects. You're just saying, where do you begin and where do you end? And there's the communication made, regardless of what format or whatever. I saw blockchain as really the transaction protocol. And at the risk of looking like you're going to try and take over the world, I'm saying if you've got an ability to say, where does your transaction begin and end? Yeah. And now you've got a common language between the protocols. We're not affecting the life cycle engines. And you just mentioned it. Outside of transactions and trading, you've got risk engines, you've got regulatory reporting engines. You've got to be able to feed all these machines. But the idea is and this is the irony of what we think is that the common language is there. It's called accounting. But the problem is that everyone does their accounting at month end or quarter end. It's the last thing you do. And think about it. Every company in the world has to publish their books in a common language, but no one's thought to bring that common language to the front door, because if it's now consistent, and again, and mechanically, if you're settling a bond, if you're settling an equity, it's just a transfer. It's just a debit and credit. So if we believe, that's part of the sort of lingua franca of, it doesn't change your life cycle initiation. I've executed this trade. Okay, I now need to just do the accounting to settle it. But that means I'm agnostic to what it is. So they, regardless of asset and regardless of transaction, they all settle through the same mechanism. But better yet, what blockchain is like the internet, a network of networks. If you can control it, ideally in those situations, that's what we see. Initially, it could be a network that just has critical mass and gains the efficiency of blockchain, which is peer-to-peer settlement, real-time, instant ledgers, and you've got all the data you need around you in a shared distributed ledger, which is secure. Eventually, you can have network to network, but I think that's where the future's going to go. That's the linkages to technology, but trying to create communication bridges or other things is just sort of avoiding the real issue. But again, and I'm a reluctant as an operations guy, I'm a reluctant accountant, but I've seen that most of my problems have been fixing all the accounting retroactively, and I was like, well, if we can get it right at the front end, the accounting takes care of itself. It's just
But there's one challenge though, Paul, which I also looked at is velocity mismatch, right? So as the industry is sort of embarking upon real world assets, which is let's tokenize the world, right? Let's tokenize RWAs, the bonds, the equities, the ETFs. BlackRock's recent middle, which is money market fund, is trying to have instant liquidity from the whole perspective. And the reason why I focus on operations, one, because it's the most expensive part of a banking operations, and people don't oftentimes completely ignore that because technology can give you this shiny little thing, and eventually you will make operation efficient. Eventually, it will come down to the fact that you're getting cost advantages by applying technology in a meaningful way for you to be able to take away all the friction and all the FTE conversation that we've had to say, hey, what is the FTE impact of this tech? But there's a transitory period where I have to deal with the old systems, the batched relay systems, the ISO 20022 and the MT system that come through processing friction, processing exception, for example. And then I also have to deal with this, which means that technically you want to design a system that empowers the operations, not have to worry if the asset is coming through digital channels, tokenized digital channels, or your messaging digital channels, because at some point they all have to be realized in the book of records, whether it's the asset coming in or asset going out. And it's a temporary phase. We still have to deal with that whole thing. But once you make it sort of ubiquitous and seamless, then you can transition behind the scenes to all tokenized assets, because operations still would not care or would know if an asset is coming through. So there's a velocity mismatch challenge, and we can solve that through, again, creating conduits. And I think the T+1 and many of the traditional finance industry. So I'll say that, and I'll leave it there. But I have one more thing I want to touch upon, and Paul, I'd love to get your perspective. Is it's interesting for banks because the FinTech ecosystem, which has been evolving for past 20 plus years, whether we need to do a SaaS model for treasury or do a real-time payment system, whatever, So suddenly for a financial institution, which is laden with legacy infrastructures, with mainframes, and me and you are coming from IBM, and you seen the legacy system, have seen that world where you have still the COBOL system, still the core banking system tied to mainframes.
Yeah.
And now banking has made enough investments either in FinTech or trying to understand how to do these things in cloudification. Now they have another vector to deal with, which is blockchain, which is completely, the Web3 is completely antithesis to the decentralized cloud infrastructures. So it's a hard thing for banks to navigate these things because they only have so much time in the day and skills. I don't think banks are very known for attracting the best skills in the world anymore. These are hard places to work and still laden with a lot of legacy system. To me, talent and application of acumen is the biggest challenging ensuing the market infrastructure, who understand these systems not really from tech perspective, but markets perspective per se. So I'll pause here.
No, that's I agree with you. I mean, the banks really are oil tankers. They don't change direction very quickly. A lot of the big banks now are embracing FinTech and innovation because they realize they've got to bring in new technology, and it's not necessarily going to be grown in-house. It's interesting. Two things I'd say is that we've seen a lot of interest in internal use cases because they're in control of all the assets, and it's just the book entry, inter-entity transfers and things. The other thing as well is I've got some criticisms of Biddle, but the idea that you've got digital funds or digital investments natively, you can create native digital assets. This is a way for the traditional banks to get a handle on something that's now pure and show how to operate it and control it and be efficient. And then really the interesting thing about, say, like the Bitcoin ETF, and we've always been saying, we have a way of introducing assets to digitize, and we effectively escrow them at a custodian or depository, and then you create a digital asset. Well, that's tokenization, but that's what an ETF is. That's what, think about it. They locked up the Bitcoin, and now they create a share on the New York Stock Exchange, right? And so the Bitcoin ETF is just a form of, ironically, traditional finance tokenization. But if the big banks can get the pure thing right, then they realize they're only an escrowed asset away from actually absorbing the traditional financial assets that can now be digitized and leverage the technology internally and between themselves. But and again, to your point, while I say, I often go to the banks and brokers and say, look, you still have to meet your regulatory requirements. So you're kind of safe for now, because if we do introduce this, it's still going to operate in the legacy regulatory environment, and your role is somewhat secure. The problem you've got is that you've got to transition from all your legacy infrastructure. But if you look at your competitors, and I often said this, if you'd have said to a telephone company in 1996, that nascent online bookseller, Amazon, is going to be your competition in 15 years from now, and they'd be like, how and what do you mean? It's like, well, it's going to start selling everything, and then it's going to be content. Then connectivity is not the product, it's content and streaming. All right. So I say to big banks and brokers, what do you need in terms of a transacting network? Well, you need a network of clients who are linked with each other. And who are the companies that have them? Well, they're everyone. They're Google, they're Facebook, they're Walmart, they're Verizon. But for a banking license, which most of them have actually a minimal banking license to handle certain transactions, they can now enter this world. And someone said, if Walmart said, here's the Walmart 401k, you'd say, okay, that's cheap and cheerful and it does what it's supposed to do, but they don't have to transition from COBOL mainframes. So there's this huge potential that the technology could open the door. All you really need is the correct licenses, regulatory and compliance and risk management. And many of these, financial services and transactions is going to become, like I said, it's not going to be the access to the financial markets that's key. It's going to be the content of financial transactions, and that's where many industries. So that's mine.
No, absolutely. And I'll think to some of your points, Paul, is I think you're spot on from that observation in terms of how these large financial institutions And I would say this, that I was in college and I'm dating myself now when FTPs and everything else, and people would wonder, like we would go to information brokers. These are people who are involved in simply moving information, the green screen scrapers and the travel agencies and
Yeah.
and it's, say, fine, you're FTPing a file. How does it affect my business? And my question to them was, you know, you're you're able to move these files, this information at a much faster pace, as opposed to either sending them through, those runners. And yes, lo and behold, 20 years later, we don't have, we've taken the Sabre system and Amadeus system, which are largely travel systems, and made them available to you through Expedia. And so while we don't have the travel agent on the streets and big powerhouses, we still have the need to travel. And we have gone to Expedia and Trivago, who have taken just the act of booking tickets to giving you an experience, to say you can book everything in one place. So I see the transition in financial services too, that the roles of bank will shift from being the engines of, which is the longest debate, we need banking, but we don't need banks, which is the famous quote from Bill Gates, to say, can they be the entities that we trust and own the fiduciary mantle, own the prudential treatment of asset mantle, own the KYC AML, which is required for ensuring that our financial system is not misused by nefarious players for nefarious activities and so on and so forth. So I think you still have a role. The only question is, are we relying on de novo banks who have no burden of legacy versus these old 200-plus-year-old banks who have so much technical debt that it's hard for them to move? And or maybe there's something in between, that the easier path is we'll acquire a company and we'll go for that perspective. But that's becoming challenging too, I think.
And I'm very wary of terms being over extrapolated too quickly. But the idea of what they say, open banking, again, if there's a common protocol and there's institutions, they're going to be offering different products, but you're going to be able to, as much as it's a process to move your bank accounts from one institution to another, with brokerage account from one to the other. Now imagine with the technology, there'll be applications that say, I don't care where your product is if you want to buy this product, it goes to where it settles. And again, that's the idea of the Web3, which is pushing it out. The users are now in control. And again, there's a long way to get there, and there's certainly issues around control and security. But again, that's where it. But think about what the internet does. You're saying, what do I want to do? And then just, it doesn't care where you are or what you're just hitting a link, and going. So imagine transactions. Okay, so I mean, it's funny, we advertise this as the best of times or the worst of times. I'd say it's the exciting times. So it's like
it is exciting times.
As much as and again, the time, and you've been involved 12 years, I've probably been involved 9 years with blockchain, and we've seen the iterative developments, but also that nothing's really broken out in massive scale, but there still seems to be this huge potential. So again, it's the issues that you've raised and I've tried to add to, I think, are real, but the potential is huge, and it's just a matter of how the world solves the problems, and it's going to be the innovators that do it. So
no, absolutely. And it's a build up, right? You see all these small projects, and while the middle is a drop in a bucket, $300 million, not a lot of money, but over time you find 5 or 6 different projects, and next thing you know, a year later you have hundreds of these projects. So you'll find a snowball effect, which eventually is how I'm expecting to see. But nonetheless, to your point, I'm still focusing that you cannot, like, we've seen the starting troubles that even Biddle had, something like BlackRock. And I spent months and months at State Street to make sure that if you're opening a wallet, the wallet is not dusted. And for many of the audiences, dusting is because you're running in open networks. Anybody can send any asset to you, including NFTs and so on and so forth. And that actually did happen with BlackRock. And now you have to deal with it. Just like if you send money to somebody's account, you had to deal with it, even if the money is not intended for the account, or you claim to say, hey, I don't have this person. The banks have to have a process to dealing with it. Everything needs to be accounted for, and that to me is something which needs to be addressed as well.
Okay, great. Well, I'm actually, I know we said we didn't want to rehearse anything and we wanted to let it go. We did a general guideline, but it's I've been fascinated by where it's gone, and hopefully the audience has enjoyed the comments. I know there was a question early on, but if who wants to put their hand up for a question? Jim Mason.
Hi, thanks. So yeah, thanks for the comments. It's very interesting to, in a sense, hear the rest of the community talk about, in a sense, the evolution of DLT technologies into the finance space. So I've been more on the traditional finance side. That's my background. So I worked as a DLT architect at DTCC and was a lot of the prototypes with Swift and the Fed and so on a lot of things. Looking at, in a sense, trying to take what is DLT technology and figure out how to make it work for the other set of transactions. So to Nitin's point, I'll say Bitcoin is its own little world, and I'll call it well suited for its own little world. It's a use case. It's not going to go away. It fits it. It actually, if you look at what it's trying to accomplish, it does it fairly well. There's not a lot of room for what I call improving that little space. But that space has nothing to do with a model for the larger world. It misses so many fundamental requirements. And I look at what I call DeFi, where in a sense you guys are focused and you're optimists as a group. I'm a pessimist, having spent 5 or 6 years there. So I don't look at DeFi as leading the way into what I call the larger use cases at all. And so what I'm into trying to do is re-engineer that whole concept. So I take DLT, and I hate to say I do this, but I do. I'll trash it and say the replacement for me is something called VSLS, Virtual Smart Ledger Services, which don't look anything like DLT as you understand it. Has nothing to do with a layer 1 or a layer 2. It doesn't look like your consensus stuff. It's not bound by the limitations of contracts. And even the concept of a transaction lifecycle, which I've worked on for more than 45 years now in real world applications, as conceived in DLT and DeFi, doesn't really fit, I'll call it the requirements of many of the other use cases. And I'm not just looking at, I hate to say this, simple things like security trading, digital assets, and so on, but look at the larger world. The larger world is far more complex. So the concept of things like tokens and stuff and digital assets, those do make sense, even in a much larger world of things like mobility, supply chain, things where you have millions of transactions in minutes. Nothing like, the simple stuff of like a stock market, right? So how do you take some of what I call the concept and move them into these larger use cases? And my only argument is taking what is DeFi, which is trying to, after the fact, engineer things like compliance and trust into it, is an insane thought. It's more like go back to the use cases, look at what they have as capability requirements for compliance, trust, scalability, all of those things, and start with the use cases and think forward rather than trying to retrofit everything where most of the community is coming from. So I apologize for the long.
So Jim, I'll tell you, it's a really, really brilliant point. And we're optimists, but I'm not drinking the Kool-Aid, if that makes sense. And neither is Paul, because me and Paul have had deeper conversation in this context. So let me first address my perspective on this, on two things that you raised, really important points. One is we can't take DeFi principles and retrofit that to existing financial infrastructure because there's a legacy to this system that we've built over the 100 plus years, as I mentioned. However, I do see composability. So I see these smart contracts and DeFi constructs. I don't see them as an avenue to deal with instruments and assets, which means I'm suddenly you're not going to create a DeFi or use a DEX and completely replace the centralized exchanges, because there are certain requirements for the centralized exchanges. I do see many of these as a platform modernization play. So there are inefficiencies, as we both know, and Jim, you coming from DTCC, you fully understand all kinds of inefficiencies, both in the issue of time and trust that leads to massive fee infrastructure, and only a few players still get to benefit from the existing financial system. And there is a mandate and task for any banking system to make it egalitarian. It's far from egalitarian today from that point of view. So I do agree, but I see smart contracts and as eventually composable services that I can take bits and pieces, whether it's settlement finalities or whether it's looking into ensuring that I don't have settlement happening in a different layer and actually having asset move a different layer. This is DVP and PVP type construct. I can at least bridge that gap a little bit using some of the technical element. Whether you call it VSLS or that is just a matter of vernacular.
Right.
Where my head is at, Jim, on the
Yeah.
long tail play, is today we have this notion of bankable asset. I use the word 500 trillion. Those are bankable assets, the assets that that banks have a model for, and we understand how to value them. But there's a whole slew of things that the digital world is coming up with, especially in the emerging economies. And trust me, I've traveled to 90 different countries to understand these things from that perspective. Whether it's, and again, I don't want to belittle the craziness with NFTs and everything else, but there are certain elements of the new age economies that aims to AI is monetizing data. So how do we monetize our data? Today, we have no model in data monetization, whether it's your healthcare record or your credit history, whatever. You absolutely have no model. But let's say there are some legal framework in the world that lets you monetize the data. You suddenly see emergence of new asset classes that never existed before. And these are digitally native asset classes. And I actually had this conversation at Federal Reserve in Philadelphia to say our payment system is great for where it is today. But if we were to go into this hyper financialized world, then you need a different transaction system that takes its lessons from DeFi and the financial infrastructure. I'll leave it at that because a lot more layers to peel there. But I'd love to get Paul's opinion on that. Those are my two elements. We're not drinking the Kool-Aid. We're optimistic, but I'm not drinking the Kool-Aid yet.
Yeah, and if anyone knows me, they know I've been a long-term critic. I'm being diplomatic here with some aspects of DeFi because I've over time I've recognized that you've got to see some of the potential and innovation and other lessons that can be learned. But to your point, Jim, I go back to my original point, which is a lot of this development has been done iteratively and not holistically. So when we looked at the problem, you'll often get the use case. Alice is going to sell Bob IBM shares. Okay, so you can transfer a tokenized IBM from Alice to Bob atomically at the same time as cash from Bob to Alice. The problem with that is that that's not really real to reality, because if Alice is a broker, she's about to buy, borrow, or get back from loan those IBM shares. They're not sitting in a bucket waiting to be transferred. And by the way, Bob doesn't have the money either. He has it in a money market fund. So what you actually have to record is the obligation of the execution, right? Because you've got to have payable receivables, because you're going to say, I have executed this and I will settle it. Now, in today's market, now we go to T+1, but in an intraday market, you could say, I can, in the same way you price a bond to saying it's good for 5 minutes, you may say, I'm settling this in 5 minutes or 5 seconds, all right? But the point is that you need to be able to record the obligations, because there's a chain of events that are dependent on those assets. And the problem with a lot of blockchains is all they do is record fully paid for long transfers and nothing else. They have no concept of the future. They can do transactions today and they can show you what's happened in the past, but they can't record anything in the future. So our layer 1 protocol actually has transacting periods with payable receivables, so we can do intraday netting and financing, which is the key, because most of the industry runs on leverage or collateralized positions. And without payable receivables, without transacting periods, without intraday netting and financing, you don't have a holistic solution. And believe it or not, despite the 9 years of experimentation, most of the peer-proof concepts haven't gone to this stage. They haven't really realized that they really need accounting and future date payable receivables. And that's the problem that we believe we've solved, that they haven't. But we thought of it from day one. Unfortunately, it's taking a long time to get it up and running and convince people. But
so I'm pretty sure I didn't convert either one of you, but you both are leaning in the direction of what I call complexity, which tells me that you both understand, you both did the same thing. You went back to what I call whatever key use cases you looked at, started thinking about what the requirements for successful capabilities would be, and then come back forward, which is actually the right approach, in my opinion, to try to evaluate what's out there and come up with strategies, whatever you want to do. But the most important thing is you're going back to the use cases. And that's exactly the same process I did. My only difference was I came to the conclusion that the existing technologies were pretty much not helpful on the DeFi side to build from. Well, I think it's easier to reinvent them and to try to make them successful. That's all.
That's why we redefined Tapestry X from scratch. And believe it or not, we've got 5 fundamental building blocks, and we can do any transactional life cycle. And within our network, there's only 15 accounting interpretations that can cover every transaction in the world. So we've gone back to a fund. I can date myself to my college days. I actually had to code in machine code. So you're back to Boolean logic, and like I say, to me the debits and credits are like binary, and really the accounting applications are really like the machine code, the transaction life cycles. So, but if you get it back to fundamentals, it's amazing how consistent transactions are at the fundamental level. It's, and I'm an engineer, an aeronautical engineer that came into financial services. And the way I framed it was, the problem with the industry is, although it's all debits and credits, there's 1,000 debits and credits, and they've all got their own names in interest, a payment, a principal, a collateral, blah, 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 And the problem is the industry participants learn it by rote in their silo. And what they don't see is that a payment, whether it's an interest, a principal, or a dividend, it's just a transfer of money. It's mechanically the same. It's just called something different. And so they say, I can do a dividend, but I have no idea what an interest payment is. And it's like, it's crazy that the industry has become that separated, but bring it back to its fundamentals. And that's where I'm saying the combination of what is the fundamental of a financial transaction in accounting and this new technology, and you've got something that can really move the world.
Yeah, so one more thing, Jim. While you're not converting us, I'm also not buying into the whole thing that we have to change our financial system one way or the other. It's not going to last forever. So I'm not in complete unison of that agreement to say, hey, we should leave the way things are. I also don't have a America-only perspective. There are challenges in the world. Your comment on complexity. We have a complex financial system because it is the largest in the world. It is the most regulated in the world because transparency attracts capital, and we've enjoyed that, for the longest time, since the Bretton Woods sort of agreement and everything else, and since we became the reserve currency. That complexity has a burden. And where I'm heading at is that if you see the systems around the world, there are a lot of conversations around simple things like tokenized fiat, which is whether it's CBDC, stablecoin, any function of that. Now, when you begin to go down the path of leveling the playing field with the settlement systems, it is bound to impact the other asset classes, because now the other asset classes converge into the settlement system. At some point, it's that fiat settlement that provides a universal fungibility to all the asset classes per se. And you fix that problem, suddenly you'll find the other micro infrastructures will converge in that model. But anyway,
I'm quite conscious of time, but the Locklear Group have they raised? I'm not sure who's the
Yes, that's me. My name is Ross. So thanks, Nitkin, and thanks, Paul. So Nitkin, I question Bitcoin L2 networks. So we have a Lightning, Stacks, Liquid, Merlin, Satoshi, VM. What do you think? What the heck is the future of those? Reality, and what do you think? So direction is going for those, or any similar? What's your crystal ball?
Yeah, so two things on this. I just came from Hong Kong Bitcoin conference. I'm heading to Nashville. I'm very interested in Bitcoin for all the things that Jim mentioned. It's his own asset class, the marquee asset class, the structural asset class for crypto per se. Two things is, one is pros and cons. One is there's an argument for ossification. Don't change anything. Bitcoin is as good as it is. I'm not in that camp, only because technology needs to evolve and change. You cannot rely on something that's 15 plus years old or whatever. So layer 2 is meant to solve one, scalability and speed. So that's one thing. Second thing is layer 2 with the BitVM constructs is taking away the Turing complete element from executing smart contracts, for example, on Bitcoin, which is sort of a negative element to the existing sort of structure from Bitcoin point of view. Second thing I think is it's important that Bitcoin liquidity, which is lion's share of the ecosystem is tied to Bitcoin liquidity, it has to find its way as an investment instrument. So Bitcoin is a store of value, and it has to find its way to getting a 4 or 5%, with this staking or restaking ecosystems in the Ethereum and Solana, world, and it participate in as an investment asset class, which is not the case today. So today you have to go with Bitcoin converting into some wrapped asset, which has enormous amount of technical risk and counterparty risks from that perspective. So layer 2, whether it's solving for scalability or solving for bridging, and there are 48 for my last count, 48 projects who are trying to address that whole thing, is trying to solve for those. And I think that it's time, and it's gotten a lot of investments in this year alone It's taken that only because it becomes so big and so structural for crypto that the Bitcoin holders, the hodlers, are salivating over all these returns that you're expecting in the Ethereum and Solana ecosystems. And we are finding a way to allowing them to participate in that ecosystem without taking unnecessary counterparty risk that they have taken, whether you're trying to lock your assets in some wrapped asset and there's some technical, then at that point you lose your asset permanently. There are new projects that came, it gives you enough control. So you have control of the asset, and yet you can participate in the high yields that staking protocols have to offer. So I'll pause here, see if that made sense. But
my question goes to Jim Mason. How could the implementation of a blockchain-based taxation model expedite processes and improve efficiencies within the larger financial framework?
All right, so I'm not going to take time, but I'll say in 10 seconds, I think back to Nitin's point, that you look at what you're trying to do. You're not going to use existing systems, as he says. They have to be modernized, revamped, re-architected, whatever you want to say. He's 100% right. So we're not saying those systems as is have any significant value in the next world, I'll call it, that we need to get to. All I'll say is that that's one small dimension, taxation, of many of the dimensions that are on what I call typical financial transactions, which include compliance, trust, and all kinds of other dimensions as well. And back to Nitin's point, you need to go back to the use cases, break it down. So I took what is a transaction lifecycle in finance and changed it. Said, nope, the way it's conceived now doesn't have the right steps to accommodate these things. We need a different lifecycle. We also need to change the concept of consensus. And we also need to change the concept of things like the concept of a wallet. Doesn't make any sense. It actually doesn't make sense to people in the sense that you all have wallets, and yet your entire wealth or your net worth is not sitting in your wallet. And so, you know, as Nitin would know damn well from what he's done, that it's all about what I call trusted asset custody services. That's where your wealth sits. So how do you get there? Ask Nitin, because he's probably been spending 5 years or more on that problem.
Okay, if I could just make a couple quick announcements. So I just want to show you just one or two things real quick, and then I want to turn it back over. We do this meeting every month. So if you would like to participate in this or any of the other meetings, if you go to the GBA website under events, and so under the event calendar, you can see all the events that we have. Like Paul said, we do this one on the third Monday of every month. If you'd like to be notified about things, under news and information, we have this thing called newsletters. And if you go here to newsletters at the top here, you can sign up for the newsletter, and that way you can be informed about right up here. Join our mailing list. Right. The next big event we have is called the Government Blockchain Showcase. We're bringing government folks from all of these different federal agencies, other national governments, state and local, private sector to come and to see what are the actual real solutions that people are doing. If you have a solution that you'd like to promote, we're publishing the GBA Emerging Technology Directory. So if you'd like to submit your listing there, this is free for GBA members, and there is a listing fee for non-GBA members. Companies that have been certified essentially will be at the top. We can talk about that in a second. The next big conference we have is Blockchain and Infrastructure. That's in November. And all of these you can find underneath the event calendar. If you want to be able to prove or demonstrate that your solution can be trusted, we have the blockchain maturity model, which we'd be happy to give you more information. And we've published a model law. There's 150 countries that do not have any digital asset or cryptocurrency laws on the books. So the GBA has published a model law for distribution to those countries so that they can debate them, they can tweak them for themselves, and come up with a regulatory framework that has some consistency. So I just want to share that. If you have any questions about any of these things, send an email to support@gbaglobal.org. We'd be happy to talk with you about this or any other stuff. So I just want to throw that out there real quick, Paul and Nitin, and the floor is yours for anybody else who wants to stick around and for as long as you guys have.
Yeah, I do have to drop, but as I was saying earlier, I really enjoyed this conversation. It's something refreshing to not have a crypto bro conversation, to be more pragmatic, and that's why I've enjoyed the chat with Paul and Jim. Really enjoyed the questions, which I think it's really important for this community to engage in solving this in a meaningful way. It's very hard to have these conversations in the crypto bro land, because it's for them, it's all about tokens and blockchains, and they have little understanding of the system that we all have, worked with. So thank you for that.
No, thank you,
Thank you,
Nitin.
Paul, for the invitation.
Thank you, Nitin, for your contributions, and it's a great conversation as we've always had. So we thought this would be good. I really enjoyed it.
Thank you.
Thank everybody for being here and listening, and again the great questions as well. I think we're all on point. So
And thanks
thank
to
you,
GBA.
everybody.
I mean, it's
Yeah,
important work they're doing here. Thank you.
Great. Thank you, everybody.